Good afternoon, everyone, and welcome to today's Wealth Creation Show. And we are going to talk about inflation versus investment, and particularly how your investment helps your money from being eroded by inflation. Now, we probably will talk quite a lot about property investment. Jim, that's your method of investment and being quite successful at that, and how that's saved your money from being eroded and built wealth over time. I think firstly, if we just kick off and explain a bit about inflation, because not everyone's 100% certain about what actually inflation is, how it works, and how does it erode your money. And inflation itself is categorized as the rate in which your general price level of goods and services and things, as they rise, they reduces the purchasing power. So to kind of simplify it, if inflation is, I think we're 4.7 just now, inflation. But
is that really thinking? Is that really explaining it in a layman's terms? I mean, the reality is this cost £1.
Yeah.
Next year, inflation's at 5%. So, and by next year, so this next year will cost £1.5.
Yeah. Okay, that's
so. If you've got £1 now, and you're sitting with it in your hand, £1. By the time you get to next year, that £1 will be the equivalent of having to buy like £1, 1.5, £1.5 divided by £1, which will be 97% or something like that of the value.
Yeah.
So every single year you weigh that pound. It's a classic example. We all know what we bought when we were younger. I've got 5p. What can I do with 5p? I can buy a Counteract bar. That was a classic. You'll not remember that. But that was the classic. I've got 5p. What can I do with 5p? I could buy a bar, classic, not a classic, but a Counteract bar. You would be lucky if you got a Counteract bar for about 70p now.
Yeah.
I don't know how much they cost, but that's how inflation's eroded. So the 5p that you had to buy that Counteract bar, if you do nothing with it and let it sit, can no longer buy a fraction of that Counteract bar. It could probably get a bit of the paper. So that's how inflation erodes over time.
Yeah, and that's where your money erodes if you've got, if people are quite like, well, let's save. If you're saving money and it's just in a bank account, or what people used to save in jars and all the rest of it, your money's just eroding because it's not working against inflation to produce, obviously, more money.
Yeah, and it's a misconception by the public thinking that if they've got their money in a bank account, it's actually going to be okay. Because the reality is the bank account is probably getting 1% at best. So if inflation is sitting at, well, where is inflation just now?
I think it's 4.7. I checked last week when I looked. I think it was 4.7.
Inflation rate. We are sitting at, current inflation rate. It says at the Bank of England, according to them anyway, they're sitting saying it's the current inflation rate's at 3.8%.
Oh.
But there's different measures. Other people come out.
That's not what I said last week.
But this is just via the Bank of England. This is what happens about monetary policy and inflation and all the rest of it. The Bank of England comes up and says, well, the current inflation is at 3.8%, and it's 2% as the target. But other people come out with, well, if you take into account core inflation, which is the taking out the mortgages and and the sun and the moon and the mirrors and the smoke and the mirrors that we use, it's like inflation, core inflation is really sitting at 8%. If we exclude services, or if we include manufacturing, if we exclude manufacturing, and other people, economists, come up with different measures of inflation, and it's really to predict the underlying principle. Because if, for example, if food inflation on its own, could be sitting around about 6%. But if services inflation, in other words, people are doing financial services, people are doing estate services like us, people are doing property management, people are selling a service and not a product. If service inflation is below the 3.8%, then that's why that's at 6, and that's a lot less, and then it comes out at 3.8 if you add them both together and average it out. So that's why you get economists going, well, what's the core inflation for food? Because that's what everybody has to live on every single day. I mean, most people can do without a service.
Yeah.
Because it's just a service. That's it. Most people can do without buying consumer goods, but they have to buy food.
Yeah, and food
So
inflation's a big topic just now.
So this is why you want to look at core inflation and see, and without services included, and see how much food is actually costing everybody, because that's where the real money. That's where it's going to take a lot of money out of the economy, based on food inflation. Because as I say, services and stuff like that could be could just be a choice. That's it. Whether you want to use a service or whether you're not, everybody has to eat. It's a fact. That's why these businesses are good ones to invest in. That's why Warren Buffett is like a big fan of the core businesses like Walmart to invest in, because they're selling food every single time, and people need food to live. That's it, in a nutshell. So yes, inflation erodes. Just having it in the bank is going to continue to erode and eat into your numbers all the time, and it's going to it could eventually just wipe you out. If you've got $100, for example, I see somebody's from America here, maybe Alabama, possibly. If you're in the UK, you've got pounds. If you've got $100, £100, €100. In 10 years' time, that €100, $100, £100 will not be able to buy the same goods and services it does now.
Yeah.
Okay. Does that make sense?
Yes.
Yeah. So that's really what it comes down to, the core inflation and underlying figures. That's why the Bank of England is so adamant that they have to get inflation under control. And that's what the primary reason is, because every amount of money you're putting aside for your pension, for anything else, it's just continually eroding at that every single time. That's all it comes down to. So your pensions are getting eroded, your savings are getting eroded, your money in your hand, literally. In some countries like Brazil and Argentina, the inflation goes up almost so quick in one day that it almost wipes out everybody's savings overnight. This is the old joke that they used to say about people were wheeling about money in a wheelbarrow in these countries to buy stuff, because the money that had accumulated was basically worth nothing in context, because inflation had destroyed it completely. So what cost them $100 the day before, or £100 or €100 the day before, was now costing them 200. We saw that classic example when it came to some goods in COVID, when lockdown was on. Look at the amount, look at how the price of, for example, kayaks doubled overnight. A kayak was £800, and then overnight, because of COVID, it suddenly became £1,600.
Because they were in demand. People were using them.
Well, supply and demand, but also, and effectively that was pushing inflation as well. So these were all inflation. What about energy levels? Here's a classic example as well. Look at what happens in Russia. If something happens to Russia, or if something happens to the oil producing nations, it has a tremor shock right around the world. And what happens is, because something happens to the supply of oil in these nations, and also in America as well, and the Arab nations, what happens if something happens to the, or supposedly might happen to the price of oil, oil shoots up per barrel, and therefore the cost of petrol and everything that oil makes, plastics and all the rest of it, goes up as a result of it as well. And that's what causes inflation. So this is why we try our best not to fall out with each other as countries, and we try our best to resolve our issues without actually physically having to go to war, because that doesn't help anybody.
Yeah, and it's when you explain it like that, and it just really demonstrates how much of an influencing factor inflation is in everybody's life, and a lot of people don't even have a clue what inflation is, or how it works, or how it affects them.
First time I saw this happen in real terms, and in almost a day, how inflation doubled overnight, was, I think it was the Suez Canal crisis, or the Panama Canal, or something like that.
Yeah.
You know, where the oil tankers come through and they take the shortcut. Yeah. Something happened in the crisis in the Panama or the Suez Canal, where the oil tankers come through, and it was when I was maybe about 1978, 1979, so it'll be about 10 or 11. And I remember my dad going to the petrol pump, and what was 33 pence a gallon of petrol was 66 pence the next day.
Doubled,
It had doubled overnight, a gallon of petrol. Now, admittedly, nowadays it's like a gallon of petrol, because it's about £6 now. But at that time, it had gone up to 66 pence. It had doubled overnight just because of that crisis. So it shows you how, I mean, that was 100% inflation, really.
Yeah.
And that was at the time in the 1970s when we had the winter discontent, where inflation was sitting at 27%. And interest rates were at 19, base rates.
It's crazy to think that, but obviously that was what it was at the time.
Yeah. So this is why we know by historical purposes how much damage inflation does to an economy. That's why it's probably the primary target and the primary objective of a country is to curb inflation as much as they can.
So this is why then we talk about making smart investments that can, counteract the inflation and grow your money rather than it sitting in the bank, and grow your money at that higher rate than what inflation is.
Well, this is why, I mean, we'll take you back to investments. This is why the great thing is for example, rent controls.
Yep.
So rent controls are coming in 2026 or 27, maybe, in the Scottish Government.
Yeah.
I mean, they're going to give cost price index +1. That's all right. So you're getting inflation plus you're getting 1. So you're getting a rent increase of over 1% over what is inflation at that time. We can't quibble at that, really, because you're always getting more than inflation. So why would you then go, that's not fair? Because you've got to fix something that you've neglected for a lot of years.
If you've not obviously brought your rents up to market
and
value.
Well, it's not brought your rents up. You just completely neglected the property, the investment. You've completely let. It's almost like watering a plant every day and then suddenly deciding to take a couple of weeks off and not water it for 2 weeks and thinking it should be the same.
It's got to weather, yeah.
Absolutely. And this is what happens to your investments and your savings if you don't do that as well. You don't. I mean, your savings really. I think your savings and investments are in my mind, are two different things. Your savings is what you put aside in cash. Unfortunately, you usually don't get a fantastic return on them, and often the savings are actually eroded by inflation. Your investments are different. They're things like pensions, they're stocks and shares, they're ISAs, it's property, it's things like that as well. That is what usually typically outperforms inflation. Now, I'll guarantee you for a fact, if you do property investment, it will always outperform inflation if you do it correctly. Anybody out there that says it doesn't has clearly done it wrong. Clearly not got a clue what they're doing or understand how to do proper investment. It same comes to stocks and shares. Stocks and shares has always outperformed inflation. Let me see if I can talk amongst yourself. You can just, what's your thoughts on this, Richard? Because I'm going to get up a graph and show you.
Yeah, that'll be good. No, yeah, you're absolutely right. And property investment, if done correctly, now whether that's residential letting, whether it's commercial, whether it's even people buying property, doing up, flipping it, obviously making an income that way. These are all property itself is a tangible asset. So you've got that tangible asset there, which then you could then increase your investment against inflation because of these appreciating assets. Rising property values, as general like price levels increase, property values usually rise too. And it's again with we talk about rental income, increasing rental income. Rent often adjusts upwards with inflation as well, and that maintains that kind of real income as well. And like you say, when here in Scotland we've got the pending, the areas where we're going to have sorry, you got that there?
Okay, well, let me show you where we are right now. Here's the FTSE 100 over the last 5 years. Now, personally for me, I think most indexes outperform inflation. So FTSE 100, the NASDAQ, the Standard & Poor's 500, S&P 500. So there's the FTSE 100. Let's just take this over 5 years. Okay, so we can see it's gone up 60.4% in the last 5 years. So 60.4% for the FTSE. So let's just take a note of that. FTSE, 60.4%. let's look at the Standard & Poor's, S&P.
Yeah.
There you go. S&P 500. It's gone up 92% over the last 5 years. See that in there?
Yeah.
That's where we're looking at that. So S&P 500 has gone up 92% over the last 5 years. Let's look at the NASDAQ. So the NASDAQ 100, it has gone up over the last 5 years, 112%. NASDAQ is, I mean, that's basically technology stocks. Okay, so that's things like Nvidia and stuff like that.
Okay.
So FTSE 100, 60%, S&P 500, 92%, NASDAQ 112%. Now we could go on for this, but generally this is the trend that usually happens. Now let's take the Bank of England calculator for the Bank of England. So we'll take £1, and in the last 5 years up to August 25. So in August, what are the cost of goods and services in August 25, and the cost in 5 years before 2020? Okay. So it's probably the other way around. Excuse me. That's fine. August 2025 here. 128. So basically, it's gone up 28%, hasn't it?
Mm-hmm.
So in the last 5 years, inflation in the UK has gone up 28%. See, because a pound is now £1.28. It costs you to get the same goods and services that it cost a pound 5 years before. So have I clearly explained to everybody how these indexes actually outperform? So inflation's gone up 28%. The FTSE's gone up 60%. Standard & Poor's has gone up 92%. The NASDAQ's gone up 112%, almost 100% above what inflation's gone up in the UK. This is why I talk about investments, how important it is for investments. This is what Warren Buffett talks about all the time, the Oracle of Omaha. Mm-hmm. And this is what Ray Dalio talks about. This is what Tony Robbins and Mastery of Money and everything talks about all the time as well. Boring pays well. You don't need to be a master here in terms of investment strategies. All you need to do is find out a low-cost entry investment fund. And I'll explain to you in a wee minute what I mean by that, because we'll go over that, how much that erodes you if you have high fees on your, because that, I mean, that's another show in itself, but I'll quickly show you what happens. So what happens is you've got the 28% inflation in the last 5 years, you've got 60% the FTSE 100 has gone up, you've got 92% the Standard & Poor's has gone up, you've got 112% the NASDAQ's gone up. You cannot tell me that these don't outperform, because they have since time began. If I can take you right back to when inflation started and measure it against all these indices, they'll be exactly way beyond them as well. And property is exactly the same. In the last 5 years, property has gone up significantly as well. Certainly more than 28%, I can guarantee you that. Plus the fact you've also earned an income out of that property if you've done your numbers right. So that's even gone up even more. Mm-hmm. So anybody out there that tells me that doesn't work hasn't got a clue. They've got shit for brains. Let's just say that, because they don't know what they're talking about. Then they've not done their research, they've not done their information, and all the rest of it. So these clearly go up. What you have to do though is, if you do invest in these funds, you have to make sure the charges are as low as possible to do that. Now I'll give you a classic example. My Standard Life pension. I actually took the tax-free amount in because I could make more out of the money I can make my Standard Life pension, my tax-free amount in my property and invest it in property than I can make out of my pension. So it's tax-free. I may as well take it and actually make money make hay while the sun shines, is the expression. So I've taken it out, but I've actually transferred it, and I've transferred it into a low-cost, the same fund, but now it's not in drawdown. So it's not in drawdown. So I've only drawn down the tax-free element. I've not drawn down the taxable element. So therefore, I'm still allowed to put in up to £60,000 into that fund if I want. And I'm still allowed to put my own personal stuff in. And I can actually get the tax back on it as well, the tax relief. So I'm still allowed to do that, even though I've drawn down on the tax-free element. But most people didn't know that.
No, they won't, because we spoke about this the other week and I didn't know that either.
So let me tell you what my charges are now for Standard Life, for my fund, which is in a UK equities fund. The UK equities fund gives me, just bear with me. till I get in. Oops, know the right password. That's half the battle. Getting the right password. Yeah, believe it or not, for some reason this doesn't go in a fingerprint like everybody else does. Yeah, 0.6% is my charges.
That's okay.
Yeah, it was 1.2 before that, and yet it's exactly the same fund. Now it's 0.6. It's half.
Mm-hmm.
It's like, what? How is that possible? And that is what erodes, just like inflation erodes at your savings, is the amount of charges that you're having to pay. Let me explain. See if I'll see if I can get a compound calculator up for you and explain to you how this works.
So these, I mean, when you say about these charges, and a lot of people won't be aware of these charges that are coming through in the background. I mean, are they displayed clearly to people, or do you really need to?
Yeah, for most people they are. For most people they are. Let me show you exactly what's going on here when you look at this. This is just like inflation at erodes. So charges on your funds and on putting in and from financial advisors and stuff like that are continually eating into your profit every single time. And I'll show you why that is the case. So I'll just click on that and add it in. So here we go. There's a compound calculator.
Okay.
Hopefully everybody will see that. So let me take an initial investment of £5,000 or $5,000. Well, we'll put pounds because we're in the UK. So £5,000 interest rate is 5%. Okay, over it doesn't matter. It could be 50 years because it's a pension. I'm putting £5,000 in every year. So deposit amount is £5,000 every year. It's yearly. No, surely it's yearly that 5% is getting added on every year, and 5% every year I'm putting in 5,000 every year. So you can get that right. The initial investment 5,000, interest rate 5,000. It goes up. That interest rate is applied yearly, 5% every year. I'm putting £5,000 in every year for 50 years, and then we'll see what happens. So I'll calculate that. So £5,000 in for 50 years. Let's have a calculate. Here we go. So basically, I've put in 250,000. Okay, it's gone up by 5%. And my fund after 5, this is where people don't get it. Look at that. You're a millionaire. Yeah. You've only put £5,000 in a year for 50 years at 5%.
Yes, so that's 1,104,000.
And this is the point. Yeah. Everybody says I can't be a millionaire. Yes, you can. Obviously, a million will buy you a lot less at that time, but the key is to outperform inflation. Yeah. So this is the point. This is my point. Anybody could be a millionaire. All you need to do is discipline yourself to put away £5,000 every single year in an investment fund that maybe produces more than 5% every year, and you'll automatically be a millionaire if you just leave it for 50 years at £5,000 a year.
And this is where it clearly demonstrates to get ahead and do it early enough and give it time to compound.
Right. Let me take a note of this. Look. See this number here?
Yep.
The 1,104,000.
Yep.
Okay.
76,988. Okay.
Well, no split hairs here, right?
Yeah. Okay.
Now, an investment fund comes along and says, by the way, I'm going to charge you 1% of your fund every year. So your interest rate is really only 4% now, because they're taking 1% off of that every year. Correct?
Yep.
Watch what happens. Now, you think that 1% is going to cost you a small amount, don't you? Let me just show you. So that 1% is going to be 500 quid. It's going to be 1% of £5,000 is nothing, is it? It's only 50 quid.
£50, yeah.
Right? And multiply by 50. Oh, it's only £2,500. Okay? So you think it's £2,500 it's costing you. But watch what happens to the end of your fund after 1% is knocked off in fees every year. 800,000. Your fund has just lost 300,000. How's that possible?
That's a big whack off. And like you say, your initial thought process would be, it's only going to be a couple of thousand because it's the 1%.
So your 1% charge on your pension fund or your savings fund by an advisor every single year on the whole fund is costing you in this scenario around 300,000 at the end. When you thought it was just £2,500.
And the other thing as well is whether that fund performs well or not, they always get that 1%.
I know, that's it. Look what happens though if this fund goes the other way. This is why you get a really good advisor. If this fund went the other way and went to 6%, where would we be? 1.5 million.
Yeah.
You've just added on 400,000. by a 1% improvement.
Mm-hmm.
That is absolutely mind-blowing, isn't it?
It is, yeah. When you look at those numbers, definitely.
This is why people don't know and don't understand how important it is to have low-cost entry, low-cost fees for running your pension. This is why point 6 is fine for me. That's okay. I am actually going to go, because I know the shares in my index fund at Standard Life run for me, and I'm going to take a note of the price of them today, and then I'm going to compare them in 60 days' time, the price, and then I'm going to compare the index fund that I'm actually investing in, the price of that unit, against the price 60 days later, and see if that is actually going up the same price.
And if it's not,
it's what the normal stock market price has gone up. Or is there hidden charges in there that I don't know about?
and then because then that's what I was going to say. Then it'll show you what's actually been coming off if it's not the same, and if it is, then what would you do then? What action would you take then?
Yeah. So this is why a lot of people, some people, this is why about 90% of investment funds actually don't perform.
Mm-hmm.
I'll say that again, 90%. People invest in investment funds, they're actually losing out. 90% are actually no performing.
And the people running it are still getting paid, yeah.
I wasn't even aware of that, Richard, because all my investment funds perform.
Mm-hmm. But then
And I just thought, yeah, everybody's fund performs. And it's only with reading Tony Robbins' Money Mastery, it's like I've begun to realize, it's like, holy shit. It's like most people's funds don't perform at all.
Money, yeah.
No wonder they're broke when they actually retire.
Yeah, they spend all these years putting into these funds thinking this is going to set me up for the future, and it doesn't.
Yeah. Now, remember, this is just what facts I see, and this is based on the facts that I'm presenting to you right now. If you get an extra one, if you charge, so if imagine that's, oh my God, wait till we see this. Imagine that scenario if you get some funds actually charge 3%. I am not kidding. So if that was to charge 3%, your 5% would now be 2% return, because 3% would be getting taken off every year. So your 1.1 million would now be worth 436,000. You would effectively be losing £700,000 with your advisor charging you 3% every year. But your thinking is only 3% of the £5,000 every year, 150 quid times 50, because it's not 7.5 grand. It's not. You're losing £700,000.
Yeah.
That's mental, isn't it?
It is. And I think
£700,000 you've lost because your financial advisor or your pension fund charging you 3% management fees every single year on your initial fund. That's mind blowing.
It is, and it makes it'll bring you into question. I think a lot of people who are tuning in, I'll probably go and check what their actual their setup is in terms of what fee
you need to ask them what you're getting charged every single year. Yeah. Now, there's a transparency thing in the UK, for example, where you have to try, and I think there is now in the America, where all fund advisors have to show their clients every single year an example of you could invest your fund somewhere else at a lower cost, and this could give you this. And it would be a lot less fees and stuff like that. I know that's what they're doing on I think it's the 401ks, the Roth 401k. A guy called Roth, for example, in America, a senator brought it through the Senate and actually made sure that this was a transparency thing, that you could actually invest in a 401 Roth or a Roth 401k in America, and it will be low cost fees. This is why going straight for an S&P 500 or straight for a FTSE 100 or UK equities or something like that with low cost fees could reap you an absolute fortune at the end. I'll say it again. You could lose £700,000 at the end just investing £5,000 a year at 5% if the fees are 3% every year of the fund. 700 grand you lose, not £7,500 what you thought it was. Because you're losing out on that money getting invested in your fund every single time. It's eroding it away. It's just like inflation when you think about it.
And even at the 1% fee, it's like 300 grand. So
yeah. So this is something people need to be aware of in terms of inflation, and also fees that are getting charged to you all the time, and how it erodes your investments and also your long-term savings overall. It's like the opportunity cost, isn't it? It's
Yeah.
like me going and buying the Lamborghini Huracan for 178 grand and then realizing that it's cost me £2 million over 20 years, because it's the 178 grand I could have invested and got even more.
There's a question here.
So somebody actually says, how do we check fees? I've been putting 20k into stock ISA, Vanguard, or World. You just go to whoever it is actually you're putting it into. Yeah, you go to, for example, you go to that organization you're putting it into and actually say to them, what fees am I getting charged?
Yeah.
But there should be a transparency bit on it saying what the fees are going to get charged. And I don't know everybody's way and how they're doing it. It's entirely up to you as an individual to ask you or whoever you're trading through or whoever you're doing what the fees are. I grant you, if you're trading through a platform, they should have their transparency on their fees. But there is also some platforms are allowed to hide fees. I mean, look at a classic example of how they hide fees in currency exchange. 0% commission. I mean, that's how they say it. Oh, it's 0% commission. Well, it's not really. I mean, it is 0%. It's like me saying, if I don't sell your property, I'll no charge you a fee. Okay. No shit, Sherlock. You wouldn't, would you? But that's exactly how 0% commission on exchange, on money exchange, can be done now. It just so happens they're buying it for 120 on the dollar, and they're selling it to you at a better rate to make them a profit.
Make them a profit, yeah.
But they're not telling you that, are they? It's like me buying. It's commodities. It's like me forward buying gas, for example, and it's what the gas utility companies do. Forward buy the unit, and the unit rate is maybe, I don't know, 20 pence a unit, and then I decide to sell it to you for 30 pence a unit.
And roll out, a higher value.
Yeah, I'm not charging you a commission for that, by the way.
But I'm still making a profit.
Yeah, of course, because I'm buying it cheaper and selling it to you dearer. And that's what typically happens with commodity trading. And that's what typically happens with stocks and shares. I mean, these organizations for stocks and shares, when you're trading stocks and shares all the time, why do you think roulette companies look at the online betting system?
Yeah.
Even though you come up and win, they still win. Because they're winning on every bet that you're making, because you're putting money down every single time with a credit card. Therefore, they're getting a fee from that credit card provider every single time.
It's just like actual casinos. The house always wins.
Yeah, you know how I worked this out? Because I had a thing called the banker's profits or something like that. And it was like, this is how to win at roulette.
Okay.
So it was all about roulette, and I'll tell you what it is. And it's a scam, by the way. I know, I'll tell you the objective of the exercise in it. So what it was you put money in, and then you keep betting on red till you win. And then once you've won on red, you change the bet on black. And once you've won on black, you change back to betting on red. Okay. And you keep doubling up your bet every single time. Now, I went from $200 to $800 doing that. It was called I'm not going to say what it's called, because people will look it up and think they should do it. I went to $200 to $800, but there's a point here. Over that $200 to $800, I had actually bet over $80,000.
Really?
Aye, like, it wasn't my money.
I was just going to say, was it? It wasn't actually your cash. It was just like the.
Yeah, it was the same cash getting recycled every single time. But the affiliate that got me into it didn't tell me that they were getting a cut every single time you were betting. And it's like the credit card companies; they're getting a cut every single time you're buying. So that's the sort of thing. So that's why you've got to watch out for the hidden costs that are getting charged every single time. This is why I was a bit reluctant about SAS and about SIPs pensions. I was like, I'm not really sure about the hidden costs. I've still not worked it out. And it's like, I'm not comfortable doing that, because actually, if I'm just getting charged 0.6, it's nothing in comparison, really, to what I can make elsewhere. That's the clear example of what happens. And that's how they make all their money. But again, it's a type of inflation, isn't it? Eroding away at your money every single time, and eroding away at your investments every single time. So when we talk about inflation, we talk about in the normal basket of goods and services. But what we're talking about as well is inflation in terms of things that you're getting charged all the time, hidden costs and hidden charges that gets charged on your money every single time you do something. Now, to you, you don't get charged that, but to the banking system, they make that money, don't they?
They make it, yeah.
It's the company that gets charged it, isn't it? But what happens is the company gets charged it because they're doing the transaction on the credit card. They get charged a small amount, but then they put their costs up to accommodate for that. So really, in essence, you're probably paying a wee bit higher for the goods and services, but you don't know it because it's pennies to you. But over millions of transactions, it's a fortune to them.
Makes them a fortune, yeah.
Now, I'm not decrying them. Remember, I am not saying this should be a cash society because cash is even worse. If you hold cash, it erodes right before your eyes.
Yeah.
And if you pay cash to someone, it erodes right before their eyes because they have to pay more money to put that into the actual business and to put that back into the bank account. Cash costs you more to put into a bank account as an owner in a retail business than it does on a card. Yeah, a card is a lot less than cash is. So I would rather do the card every single day when I'm doing transactions or bank transfers because it's a lot cheaper than holding cash and having to put it into a bank at the end of the day.
Yeah.
So that's the things that you've got to worry about. Well, be concerned about. I wouldn't say worry because you know you're damned if you do and you're damned if you don't. Someone somewhere has got to make money out of what you're doing. Because be honest, we're not going to do anything for free. No one can. And anybody expects you to do that will not do that themselves.
Yeah, I think what you demonstrated there is like, do you know, no matter what kind of investments and things that you're taking part in, there's always a need to be quite savvy about what's actually involved in that. Even if it comes down to your pension, there's going to be money made at some point, but you don't want them taking 3% off in the background.
Yeah. It's quite interesting that Electroids actually said on here, what a dynamic currency conversion. You're absolutely right. Currency conversion and currency trading is not on the pounds, it's not on the euros, it's not on anything. It's on the point basis. It's on the 0.001. So it's on a tenth of a cent, a tenth of a euro, a tenth of a dollar, or even less. That's how you're doing it from day to day. I know really good, successful currency traders. I know currency traders that were up like 600 million in a year currency trading.
God.
Aye. And then the next year they lost the whole lot. And then the following year they got it all back again. That's how crazy that world is if you really want it to be. But currency trading for some people can be very, very. He's nailed it, or she's nailed it by actually saying, "Yeah, it's a lucrative business if you get it right." I know some people, a couple live in Tuscany, and they both just do a day-to-day currency, and they don't do any involvement. They actually automate the whole process about, just the stop loss and the time to sell. They set all their targets. So what happens is that when it gets to a certain point, they sell out and they trade it, and then they're making a profit. If it starts to drop, they bottom out. They bottom out at a certain level and they sell it off. So the stop loss. Because most people lose money on their losses rather than actual gains. I'll say that again. Most people lose money on their losses rather than their gains. So you want to minimize the loss as quick as possible because you're more than likely to make a lot of gains anyway, irrespective. And that's how that system works in terms of how you do it. Now, I knew a couple in Tuscany. They lived there. And all they did was like the tweets that sent them on their phone. And I was like, what's all that about? Twitter? What's that? Oh, we've got it. It signifies we know when to buy, know when to sell. And all they did was make a couple of £100 a day on spot trading, it was called, and exchange. And they were making 100,000 each a year just on doing that and automating it. And so it's a good business for people to understand it. It would be a business I'd probably get into. But property business, the property business is so lucrative. It's like I don't need to do anything else. It's just a shiny penny at this point in time.
Yeah,
and that's the point. Yeah, but hopefully, I've gone around the houses and I've actually done other things as well. But hopefully, I've explained to you what inflation does to you and how it affects investments and how it affects your pensions in terms of and charges that you get on your pensions as well. That is the most important things. How does property, for example, and you've said a couple of things here about how it counters inflation. Yes, it does rise. Property has always outstripped inflation for the last 50 years. It is astronomical how much property has gone up in the last 50 years. And trust me, it will still continue to go up. irrespective of what anybody else says, in some areas. Because in some areas, for example, like Britain, we're sitting on an island. There's only so much you can build on.
Limited space, yeah.
Yeah, you've limited space, and you've limited places, and you've limited resources, and you've limited infrastructure. Therefore, you can only build in certain areas. And it costs a lot more to build than it did years ago. Therefore, your property has got more value in it, or more value attached to it and appreciating later on, because it costs a lot more for people to buy new build than it does to buy a resale nowadays. Significantly more. I think it's the difference between the resale is 300,000 today on average. No, sorry, new builds about 300,000 to buy on average. You can look up the statistics. And resale properties are round about on average about 200,000. There's about 100,000 differential, about a 50% more increase. So therefore, that's why resale property that are not new build, will be more and more attractive and more inclined to go up higher in value as time goes on.
Yeah.
Because resources are becoming more limited, therefore the price of new build is getting out of there. Plus the fact they put net zero on it, on new build, and they're like, oh, we've got to do this as a net zero. It's like, you're off your head. It's like, this is just putting so many costs and so many hurdles in our economy, and causing inflationary pressure in the housing market as a result. But then that's why all the prices are going up, for that very reason. Because people are actually going, well, why would I want to buy a new build if it's going to cost me 300,000? I get the same size of property. Admittedly, it's not the same quality build, but I'm not caring about paying another 100 quid a year for my heating.
No. Yeah,
There's nothing in the scope of things.
Yeah, new builds, I mean, you're getting 2-bed terrace, semi, and semis, and they're 300 grand. And then you're coming, down the road, and you've got, like you say, older style build properties.
5 miles down the road, it's about 100 grand, that's it. And it's like, and a lot of people still haven't caught on to that. They think, oh, I need to live there, and it's like, no, I just live on the outskirts and pay half the price, and just commute into where I'm going, or preferably, or just work from home.
Yeah,
Vietnam, live in Vietnam for next to nothing, and just work remotely.
Yeah.
So this is what they don't realize. Plus the fact that rental income will still increase, and it's because salaries are still increasing, and they will always increase every single year. So therefore, there's always an opportunity, and costs as a result are actually increasing because salaries are increasing, so costs increase. Therefore, rents increase as well, as a classic example.
Yeah, and
these
that
are things. Property will never lose value over the long term.
It might peak and trough, but like you say, over the 10, 20 years.
It depends when you buy in and buy out. So
Yeah.
as soon as Trump announced tariffs on everything, the FTSE dropped to 7,500. I immediately bought a huge chunk on an index fund in the FTSE at 7,500. 1 month later, it went up to 9,000. Went up to 9,000, and it's sitting at 9,400 now. Why do you think I cashed out? I am not a speculator. I know a dead cert when I know one. And it's, okay, something might happen next year, and I'm storing money right now as a result of that. Because I know I've got a feeling in my bones. There's the sun and the moon and the mirror and the stars and the planets are all aligning right now for something significant, probably to happen next year. It's finally going to happen, more than likely, I think. All this doom and gloom that they've been talking about for 10 years, it's like they'll be telling you next year, I told you so. And it's like, I've got a funny feeling it possibly might. Keep buying property, though.
Yeah, well, that's it. You're touched on capital appreciation there and property values, and then obviously rental income as well. The leveraging your the leverage advantage of property and using the bank's money. Now, we did cover this in a show a couple of weeks ago, and it was about using obviously interest only lending to be able to purchase and then obviously build buy-to-let portfolios and things, and using that borrowed money in the form of a mortgage to buy property, and then inflation reduces the value of your debt as well during that time.
It's great, isn't it?
Yeah.
I've got millions of pounds of debt. But every day that passes while inflation erodes away at that debt, it's great. I love it. And every day that passes that I'm making money on that debt, it's great. I love it. As long as you're making significantly more money than what you're borrowing at, you're fine. And that is the key. If you look back, a lot of the other shows that we've done, we've talked about this time and time again, about risk analysis, about sensitivity analysis, about opportunity cost, opportunity loss, and all the rest of it. It's all there laid bare for anyone. It's a masterclass, basically better than an MBA or whatever it's, the best degree in the world you could ever get in property investment. I have actually recorded the whole thing.
Yeah.
How many people will actually watch it? How many people will digest it? How many people will study it? Probably very little. More than likely 5%.
Yeah.
We all know there's a 5% group.
But yeah, definitely that leverage advantage there. And then, the physical asset of a property, it's less affected by that currency devaluation compared to like what you say is your cash would be or money in the bank. But tax benefits as well, buy to let investment and things, Jim, especially in limited companies. It depends what we're looking at, but
I love it. I love it.
Yeah.
I love limited companies for property investment vehicles.
Mm-hmm.
And the reason I love limited companies for property investment vehicles is because we're no longer sole traders. We're not affected by Section 24 of the Taxes Act. We won't be affected by national insurance contributions if they try to do that on investments, because it's a corporation, it's a limited company.
Mm-hmm.
We get a lot more deductions than other ways to do things. So I love it, and that's what I love about using a limited company for that vehicle. And plus the fact that shares will be transferable to other people without actually affecting the mortgages and the loans on the company, because it's the company that have got the loans and the mortgages, not the share owners.
Mm-hmm.
Although that may be required to give some sort of guarantee or something like that, but more than likely, if you're a 60% loan to value, the bank's not going to bother about guarantees because they've got a 40% hedge there. If anything happens, they could do a fire sale at 60% and still get their money back, and that's going to be really easy to do. Because I would pick up something at 70% loan to value, a 30% discount on the value. Like I'm in there like a flash, right up a drain pipe.
Yeah, Electroid's saying Rachel will probably pay to limited companies for property fee. Possibly, might be coming.
I'm not really sure what that means. Limited companies, the great thing about being a limited company is the difficulty from the government to actually doing the legislation against a limited company because it affects every other limited company.
Mm-hmm.
So, for example, if somebody tried to do it against my limited company because it's a property company, you can't just do it because it's a property company.
It's not all limited companies
to do that.
Yeah,
you'd have to do it every single company. So Witherspoons, every single limited company in Britain, PLCs included, will actually be affected by that legislation. It's very difficult for them to do that. Therefore, that's why limited companies get away with so much in comparison to a sole owner. So I think the days of sole owner landlords will completely disappear, unless you're doing it deliberately as a cottage industry, because you'll always be a lower rate taxpayer. But even at that, or you're a cash landlord, in other words, you've got no mortgages, because I think the tax credit will eventually disappear. It'll be taken away. And I know it wouldn't surprise me if there was some indication of that being mentioned in this coming budget by Rachel Reeves. Yeah. I asked ChatGPT to put me up a poster about Rachel Reeves, and they went, "No, we can't do that because that's against a person."
Oh, really? Did it not?
I was going to try and get it to do a smash and grab, sort of on taxes and stuff like that, and it says, "No, we can't do that. That is a person." It's like, oh, really? When did ChatGPT have a conscience?
Have a conscience, yeah.
Because every other time I watch it, it doesn't seem to have a conscience. All of a sudden, it does now. Anyway, but that's the point. There's tax benefits. There's also portfolio diversification as well. I mean,
because property itself, it's a non-stock asset, so then you've got that reduced overall risk rather than if you're investing in stocks, they could go up, they could go down quite significantly. Whereas property isn't that susceptible to that kind of fluctuations.
I keep forgetting to tell everybody to hit the subscribe button to our channel.
Yeah.
Whatever platform you're on, hit the follow button, hit the subscribe button, or all the rest of it. The more and more you do that, the more and more we'll give you.
Yeah, and I've got a feeling
effectively telling you all the secrets I'm learning from all the millionaires and billionaires out there. I've got no agenda here. I am not going to sell you anything later on, like everybody else does. Same as the School of Hard Knocks is now selling $59 a month to find out what you got from billionaires and millionaires. It's like I am not remotely interested in earning any more money. I've got enough. I don't need any more. And if I get any more, I'll give it to somebody that needs it.
Yeah,
that's quite a refreshing thing for me to say.
Well, it'd be a refreshing thing for anybody to be able to say, to be honest. But yeah, I've got a feeling a lot of people are coming through YouTube today, so that's good. Lucinda's actually one of our landlords.
Inheritance tax on limited companies. Yeah. If it's a trading company, there's obviously new legislation coming in. This is why the farmers are going, wait a minute, I'm going to pay inheritance tax, try to pass this to my son or my daughters or something like that. There's new legislation coming in next year about that, where you're going to, I think it's 20% the inheritance tax rate's going to be on up to $1 million, after £1 million. So £1 million free on a trading company, and I think it's 20% thereafter. Check with an accountant. I'm sure that's what it is. If it's an investment company and it's only got property and it's just an investment company, the whole lot's getting pulled into inheritance tax. I'll say that again. The whole lot is coming in inheritance tax. There's no exemptions for an investment vehicle, even if it's a limited company. So there's other ways to do that, possibly trust management, which is what I'm going through just now.
Yeah, and like you say, the long-term security of property and things that provides that wealth preservation and the potential legacies, like you were saying, Jim, it's got the ability to pass that along within the limited company quite easily.
Yeah, definitely.
And then
you've got inflation-proof mechanisms on
you've kind of covered property.
Well, inflation 5% a year, annual increases 5 to 7% a year. Your income keeps pace with or exceeds inflation. If you think about the compounding effect, a 3% increase every single, it's only a 3% increase every single year in your rent. But remember, it's 3% on the 3%, on the 3%, on the 3%, on the 3%, on the 3%. So it's like the 1% every single day for a whole year, 365 days. It comes to something like, 1,700% at the end of the 365 days at 1% every single day improvement. So if you're moving up 1% every single year in rent, then effectively, if it was 365 years, you'd be 1,700% better off in your rent.
Yeah.
It's not 365%. It's 1,700. Mind blowing. Boom.
Yeah.
So that's the whole point about that situation. Mortgage advantage as well. I have fixed rate mortgages, 5-year deals. I do not play with finance that way. If I know my numbers work and I know it's always going to work and I've got a tolerance, I'm not caring if interest rates come down or go up or go left or go right or go up or go down or fall apart. I know what I'm paying every single month. I know what my rent's coming in every single month. I've got a huge degree of tolerance there. I don't rely on my rental income to survive. So therefore, what do I care? I just fix it into the mortgage, and that means I'm hedged against any fluctuations in interest rates or base rates, or if suddenly they go up or suddenly go down. I'm not involved in that, and I know where I stand. Come 5 years' time, if I decide to exit, then I could maybe invite other people to be an investor instead of actually the banks being the investor, and they could benefit at a better rate in the vehicle that I've got. That's probably something I might consider later on.
All right. I was about to move on to things to consider, and the first thing I was going to say is liquidity. But then that's not something that you would worry about, Jim, because you would never sell up. But that's what I was going to say. But then you never know.
Well, when you know what you've got coming in every single month, come hell or high water, you don't need to worry about liquidity if you know where that's coming in every single month. And the reality is, it's like having. I'll tell you how you make yourself. You spread your risk, because a lot of people don't understand this.
Okay.
I'll tell you what, I'll go and buy one property in London, and it's going to cost me $500,000. That is not spreading your risk.
No.
If that tenant decides no to pay, you've had it. You're out of business. You're having to finance it yourself. If I take 500,000 and buy 5 properties, though, at 100,000 each outside of London, somewhere else, maybe up in Scotland, which is easily manageable, I can then produce the same amount of return as what I did in London, potentially. I know it's probably more, to be honest. Because remember, a lot more people will buy a property at 100,000 than 500,000. Think about that. So you've got bigger demand. Therefore, the price of the 100,000 will move faster, higher than the price of the 500,000 over time.
And you're spreading the risk as well, because if you one of those properties are vacant,
one goes down, 4 are still running.
Mm-hmm.
One goes down, 4 are still running. London or anywhere, one property, one goes down, you've had it.
Yeah.
So that's the key here, is spreading your risk. So the other thing, the mortgage advantage, inflation erodes it. In 10 years, the £1,000 is worth significantly less in real terms in terms of the debt, which is brilliant.
Mm-hmm.
Maintenance costs, property values, cycles, all the rest of it, doesn't matter. Short-term recessions, who cares? Everybody needs a place to stay. It makes no difference, especially if you're working in the rent levels, which is deliberately what I did, of the local housing allowance, housing benefit. If anybody loses their job, just need to sign on and they'll still be able to pay their rent.
Yeah.
I have got no risk there. Think about that. There's people out there with properties that are getting £2,000 a month. If that person loses their job, you've had it. You'll be lucky to get them out with the legislation nowadays. With the rent legislation coming in England, and especially with the legislation in Scotland right now.
Yeah.
So if they can't pay the rent for a whole year, you've got to finance that for a whole year. Because if they're a family of maybe just I don't know, three,
yeah.
you'll be lucky if they get £700 from local housing allowance. So therefore, you'll only get £700 a month. That is not going to pay any bills. Hence the reason why all my housing is more or less in the vicinity of the local housing allowance. So if anything happens to them, they can just sign on temporarily and then they get the rent paid direct to me anyway. Again, de-risk the whole situation.
Mm-hmm.
Maintenance costs, repairs and management fees, all the rest of it. These are things to consider as well. I hedged in for all the other costs apart from your mortgage about 30% every year. Now it'll make your hair curl, or what I've got left it. But I put out a lot more than that in repairs and improvements because I've bought stock which have been neglected for a long time. So I'm refurbishing it all the time. And that's all I'm keeping to do.
Not went into it, going into it. Yeah.
Yeah. Location sensitivity, depending on region, prime locations tend to appreciate faster. But remember, there's locations that will appreciate a lot faster. Look at Leadenmouth, for example, in Fife. 170 million for the train station. 100 million for the train station and everything else. And there's another 70 million on the back of that for other things that are happening in the area. That's bound to have a huge impact on the economy.
Yeah, I think they're doing all the seafront and the bus station, and there's a few things.
Seafront, bus station, infrastructure. The buses are still running as well. They've deliberately put on buses as well to accommodate, to get people. And you've got a direct link now to Waverley and Edinburgh from leaving. A direct link. Brilliant. An hour you could be in Edinburgh, Waverley. Why are you spending an absolute fortune living in the city? Yeah, it has its advantages, but you can just travel there in an hour on the train and come back, and you can live for about a fraction of the price in a far better location. A golf course, a beach in 30 minutes, or even early, or even closer than 30 minutes away. A beach and a golf course. It's in National Geographic now. The Fife Coastal Path recognised as one of the best places to be. You've got the Pilgrim's Way. You've got all these historical places in the Fife area. This is what people don't realise, how much is invested in that area and how it's going to be, how it's appreciating value, and it will continue to appreciate in value over the next 30 to 40 years. A lot better than other economies, because it is a microcosm of the whole of Britain and the way it works. St Andrews at the one end, which is the London of Fife. Yeah. Then you've got the East Neuk, and you've got Ely. You've got all with the stars and the politicians of places as well. And then you've obviously got the other end. You've got in the middle as well the central Fife, and it's a real buoyant area for investment. So yeah, definitely that's a really good one. So that's probably location sensitivities. Whereas Glasgow and that just seems to go up in price, up in price, up in price. But it seems like you could just build anywhere in these places. They're just quite happy to build huge high rises, but you're not allowed to build these high rises where we are.
No,
that's the difference. As soon as you start building high rises, then your economies of scale and your is great for the builder, but your value disappears to appreciate quickly because they're dumping huge amounts of property into the local economy, and therefore that affects your price. and it also affects the number of people that you would have potentially lined up as tenants for your properties.
Yeah, and then that's just increased because they want as much units in the as least amount of space as they can.
Of course they do, yeah. So here's other methods of investments, because we're not going to talk about property all the time.
No.
You know what I've just said about stocks. For anybody that's got an ounce of sense here, let me just put this back on for you. That was the one about pensions I did earlier on. You want to see that and you've not seen it, then you say it. Look, inflation 28% over the last 5 years. Bank England, £1 is now worth 1.28 to buy the same thing as pound bought 5 years ago. So inflation 28%. The NASDAQ in 5 years went up 112%. The FTSE 100 in the last 5 years went up 60%.
Yep.
20% inflation. The S&P 500
was 92%.
But there might be new people watching this. In the last 5 years, went up. There you go, 92%.
Mm-hmm.
This is a no-brainer for a lot of people. They think that they should have some ounce of intelligence to be able to trade stocks and shares and exchange, and what should I invest in, what shouldn't I? Oh, I need to read Investors Chronicle. Just go for a Standard & Poor's, a FTSE 100, a low-cost index, maybe a Vanguard fund. Standard & Poor's is a classic example because it's the 500 stocks that are making the most profit. And when you're not making the most profit, you fall out of that, and the next, they bring in the next one. So they're always going to be making the best profit. That's what that is.
Mm-hmm.
And so you're always going to be in a position where you're investing, and it's a boring investment. But I'll tell you what, it pays bloody well.
Yeah. Yeah, the boring pays well thing is definitely, but people want things to happen a lot quicker as well, and that's where they fall out.
So according to your notes here, historically, stocks have averaged a return of 7 to 10% per year, which is often higher than inflation, which is historically maybe 2 and 3% every year. Your benefit as the wealth grows in real terms, maintaining or increasing your purchasing power over time. This is a long game. You can start pensions for children from birth and get the tax up to the basic rate from the government for nothing. I'll say that again. Look into it yourself. You can start pensions for children from birth, and you get the tax added on up to the basic rate. So if you put 2,880 in, they top it up to 3,600 every year for your child. You're on a winner. You're getting free money for the government for a child that's just been born. They're going to work till they die. Just take out a pension for them now. I have.
Yeah.
My daughter's sitting with 100,000 now.
That's crazy.
It's like, what? It's like...
What age is Tony? Tony's 20.
No, Tony's just 32 or something like that. 31.
I thought she was still late 20s.
Yeah, I mean, when you think about that, that's another 20 years, 25 years of compounding, and she's still putting into it. And I was putting minimal amounts into it, really. No effort made, but she's working now as well. So when you think about that as well, and then you work out my boys, I mean, they're in their 20s, mid-20s. They're a similar situation. It's like, God almighty, they've got flipping heck. You've got more money than people that are retiring right now.
I know. Good setup. But that's because you've obviously put that in place, because you knew.
It was only small amounts. And that's what build these wee seeds that you plant every single time, like money. They grow and grow and grow and grow and grow. And the next minute you've got an orchard. And then what you do is, once you've got the orchard, you harvest the fruit, and then you grow even more orchards. And the next minute you'll be like, oh my God, what am I going to do all this? I just hope they're prepared for it when they retire. I think they will be. Definitely. If they've learnt anything, it's probably that from me. So grows in real term, inflation and all the rest of it. Commodities, gold's at its highest ever right now. I've not been a fan. Gold doesn't do anything except appreciate and depreciate. Depending on who wants it at that point in time, supply and demand. It's tangible, yes, obviously better than crypto, because that's just a flash in the pan, like gamble thing. Silver's the same, oil's the same. You don't actually make any money out of that ongoing. There's no dividend, there's no investment, there's no return. It's just like, if it goes up, great. If it doesn't, well, no so great. And that's the sort of thing. So precious metals has never been my sort of thing. It is other people's thing. I know, some of my friends or acquaintances have huge amounts in gold and stuff like that. Good on them, because I remember when it was like 1,800, I think it's $4,000 now. So yeah, great. And it probably will go up even more next year.
Yeah.
Yeah, it'll go up more next year, I think, gold and silver, because obviously there's something on the horizon. You can't borrow this much money and not be able to pay it back and then think everything's going to be okay. So that's the key. This is all started from the pandemic, by the way. This is all the result of borrowing money from the pandemic and then not actually saying to people, like, we're going to have to pay this back now.
Or how,
All this money, for God's sake, live on what you can, but don't spend it all, because we're going to have to give it back. Ideally, they probably should have just given everybody loans rather than actually giving them free money.
Yeah.
Interest-free loans would have been better, like student loans or something like that, and says if you're earning over a certain amount, you've got to pay it back and take money off their thing. But they just panicked and just gave it away like it was nothing, and just caused all the pressure in the market. And there was billions running about in slush funds and people's household budgets when they were in lockdown, because they were getting all this money for free, and they wouldn't spend it on anything because they didn't have anything to spend it on.
Yeah.
All I did was invest it.
It was the smart thing to do.
Of course it was. Yeah. Okay, so finally, the benefits of investing against inflation. Would you like to tell us a wee bit more about that, Richard?
Yeah, I think you've obviously covered quite a lot there, Jim, but when it comes to when we're talking about the economy and inflation, and do you know when we spoke about inflation, it made me think about just quickly. There was a program I watched about Venezuela. I mean, they have a whole economy tanked, their whole currency tanked. I mean, it was crazy, and then they ended up adopting the dollar. But I think it was.
That's why when you go to most countries, they've got their own local currency, but they're actually adopted dollar. The dollar's the stable currency for them, because they know the local currency will go up and down like a yo-yo, whereas the dollar will stay stable for them for exchanging for goods and services.
Yeah. So there's a lot of benefits for investing against inflation. You know, it preserves your purchase power so that your money could grow faster than inflation, and that really maintains maintaining what it can buy, you know, your money, like I say, rather than eroding its actual value. Wealth accumulation, compounding your returns on investment could really multiply your wealth over decades. Like we said, it's not a quick overnight thing. You know, you're talking 10, 20 years at least. Diversification and your risk management and things, and investing in multiple assets. I know that you spoke about predominantly your property, Jim, but you also do some stocks and you know, bonds, and you know, if you mix up stocks and real estate and things, you're spreading that across and kind of diversifying a bit.
Yeah,
I know you don't like the word diversify.
You got to remember, I only had a pension because there's a really great tax deduction at the time.
Yeah, tax benefits.
Because I was a high rate payer, and it was like, okay, I could chuck it in my pension and get money out tax free out of my company into my pension. All these different things. They were great tax deductions. That's how I use it. It's just as a tax deduction.
Mm-hmm. Yeah, and ultimately, you know, income generation as well, and investments can pay you dividends. You've got the interest, or you know, rent from property and things, and that can increase with inflation as well. So that's quite good. But yeah, the long-term financial security, and I've got a bit of an image here. I'll share this with us just to.
This is quite an interesting one. Meaning us. We should probably talk about pensions, because I'll tell you what, we touched on the point of pensions and the charges that you get charged, but also the fact is, I'm really at the point of possibly even taking my pension now and leaving all my dividends in my company.
That's interesting.
Yeah, because when you look at it, if tax will have to go up every single year, tax will have to go up whether you like it or not.
Mm-hmm.
So the benefit to me right now is I'm actually better spending my pension money right now and using that at the lower tax rate rather than having to wait later on and actually taking out the higher tax rate.
Yeah, that would make sense. That would make sense, yeah.
And then I'll still be getting the same amount of corporation tax on my limited company, so therefore my dividend will be sitting in there. So corporate dividend tax might actually not go up, you see. So if dividend tax doesn't go up, then I'm better actually wait until later on. And my dividend should be my my pension for the future on my companies, not my pension. It's in with my pension provider. I'd be actually better taking that now before my dividends.
Yeah.
So this isn't me advising anybody to do that, but there's a real good train of thought, which I'm still working on my head, but I think I've got it like 95% on the nose, that as taxation changes, and I'm sure it's in Money Mastery by Tony Robbins as well, which I'm reading, as taxation changes, and it's only going to get worse in terms of the amount of tax they're going to take off you, the money you're leaving in your pension is actually going to be taxed higher later on. So what's the point of leaving it there now?
I know. Well, that's what you would think. What's the point in leaving it in there if you're just going to be taxed on it later on?
Yeah. And then it's, well, you are going to be taxed because it's now going to be taken into inheritance tax.
Yeah.
They've decided, you know, Rachel, again, has decided that she's, no wonder she burst out crying in Parliament that time. I think there's a huge amount of pressure on her shoulders. She has no idea and she's way out of depth. And I think that's why. I think that's why she broke down. I don't think she's strong enough. I think they're just holding her up at this point in time.
Yeah. Yeah, she's
to have that burden on your shoulders to know that you're going to have to do certain things and you're going to have to go against your beliefs and your words that you actually said. You're not going to raise taxes on the workers. It's like, you're going to have to raise taxes, you're not job. It's like, you're going to have to raise taxes on the work, and you're raising them anyway. You're just doing it indirect. Oh, we're going to do something for the private landlords. Okay, we're going to get national insurance for private landlords. Okay, so if you're getting national insurance for private landlords, then private landlords will put the rents up to accommodate for that. Therefore, the person is the worker is going to have to pay more rent as a tax. So they're just going to have to pay the tax indirectly. See how that works?
Yeah,
we're going to have to put corporation tax up on these companies. We're going to have to put pension costs up on these companies. We're going to have to put national insurance up on these companies. Okay, the price of goods and services will have to go up. Therefore, you're just having another tax on the consumer indirectly. So you sit and kid yourself here saying the current party in power right now, oh, they're great, they're not raising taxes on me. Of course they are. You just don't realise and you're paying it for indirectly.
It's still there, yeah.
Of course it is. Right, let's stop there.
Yeah. No, you're right. I was just going to share.
This will probably come out on a blog or something like that. AI will probably pick it up and put that one on.
Here's just a bit of a diagram just to simplify and explain what we've been talking about. Inflation, of course, eats the value and erodes the value of your money and your cash. Invest in that cash using investments, whether that's stocks, whether that's property. It grows the value of that cash, and that's how you could obviously against inflation and at a higher rate than inflation. So, yeah. But yeah, you're absolutely right, Jim. And we've done shows before about pensions and things, but it might be something to revisit because it is something that's really important. And you've got a lot of really good insights there about pensions that I didn't know, so I'm sure there's lots of other people who didn't know either.
Yeah, good stuff.
Okay, good.
Right, let's wrap up. I'll have to get the itinerary sent to you for Necker Island next month.
Yeah.
Oh, I'm no kidding. The contact man says, look, we'll have to find out what you want on Necker next month and all the rest of it. We know what I want, but I'll have to send it on to you, Richard.
That'll be good. Yeah, I'll look forward to that. Right, okay. Thanks everybody for tuning in. Jim and I will be back as usual next Monday at 12:30, and we'll see you then. Thanks, Jim.
Bye for now.
Bye.